Good afternoon and good evening to all those joining from different parts of the world, and a warm welcome to this webinar, co-hosted by KKS Advisors and the Journal of Applied Corporate Finance. For those of you that aren't familiar with KKS, we are an advisory firm specializing in sustainable investment with a vision to reshape markets. What this means to us at KKS is creating a world where business and investment decisions are made for the long term, taking environmental, social, and governance factors into account. Our team work across a combination of research, strategy, and data projects for our diverse client base that spans investors, foundations, corporates, and NGOs. We are really pleased to have many of these clients speaking as part of this two-part webinar series and sharing highlights from our collaborative research endeavours with you. This webinar is the second of two parts, so forgive us if you joined yesterday for spending a few moments with this introduction and context setting. You can see all of our speakers across this webinar series on your screen now. I would now like to briefly introduce the stellar lineup of speakers that you will shortly be hearing from, before I hand over to my co-host, Don Chu, who is the Editor-in-Chief at the Journal of Applied Corporate Finance, to say a few introductory words and give you some context to the journal's recent special issue. Firstly, today, we have Chris Pinney, the CEO at High Meadows Institute, the Boston-based think tank that is focused on the role of business leadership in creating a sustainable society. Chris will be sharing the highlights from a recent landscape study that explored how different capital market actors were integrating ESG into a decision-making and what forces are driving and hindering the adoption of a sustainable approach. Second up, we will have our very own Sakis Kotsantonis, our managing partner at KKS Advisors, sharing some words of caution on some important limitations of ESG data, along with, reassuringly, some plausible fixes. Third, we have Bo Lescott, portfolio manager at Inherent Group, a value-oriented active investor that is also a certified B Corporation. He'll be sharing how Inherent Group use ESG as a tool for achieving superior risk-adjusted returns. And last but not least, we have Tanya Bazumi, who is leading the sustainable finance efforts at the Athens Exchange Group. She will share insights on how stock exchanges are in a unique position to promote ESG transparency and leverage their institutional capacity to build more sustainable markets. Following Tanya's presentation, we will have around 10 minutes available to take some of your questions. You can submit these at any point during the webinar through clicking on the question mark on the right hand of your webinar screen, as you can see here in the screenshot. We would also encourage you to tweet about the webinar using the hashtag #ReshapingMarkets and get in touch with us after the webinar via our info@kksadvisors.com account with any questions. I'll also make sure to forward these on to the relevant speaker or member of our team. I would now like to introduce Don Chu to say a few introductory words.
Thanks, Sophie, for making the Journal of Applied Corporate Finance part of this undertaking. Yesterday we were talking about, the mission of the corporation and how it can address social and environmental problems while still providing high enough returns to its shareholders to attract capital. And we reduced that to two main problems: deciding, what kinds of investments to make in which of their stakeholders, and then once they've made these decisions, how to communicate those decisions and their payoffs to their investors. And we focused most of yesterday on the latter part, on how they interact with their investors, what they tell them. Brian Tomlinson did a great job of talking about corporate long-term plans. And I think Tanya's going to do a little bit of this today and talking about the Athens Stock Exchange and, about how that creates interaction between investors and companies, since they have to satisfy certain requirements to get on the listing. But today I want to focus a little bit more on the investment side. That is, how do companies end up deciding the kinds of investments they want to make? And I guess one of the most interesting attempts at that is the Inherent Group's investment. I think Bo might talk a little bit about this today, but they invested a specialty chemical company made a decision with a lot of advising from the Inherent Group to invest $100 million in meeting its EPA compliance. And the idea behind the investment was that it wouldn't affect their P&L, but the market would end up raising the P&L, the PE multiple with the idea that its cost of capital will be coming down. And I think that's a very interesting illustration of how ESG efforts can affect the cost of capital without affecting the P&L, and I think a lot of the efforts are going to have to be focused on that. And one question on the data that Sakis is going to be talking about. Many companies have different ways of addressing these problems, and that creates sort of a chaotic state for people trying to process the information. I think the effort to standardize the data is a very good one, but at the same time, I think companies themselves need to spend a lot of time thinking about how they can best present their own situation, their own circumstances, and that's going to require a lot of different approaches. So that, in general, I think mandating these kinds of requirements is probably going to be a mistake, or if we're going to mandate, it should be mandating, comply or explain why you're doing something differently. So, and with that, I think I'll now turn it over to Chris Pinney, and also thanks, Chris, for all the efforts. I neglected to mention that George, Serafim, and Chris spent a lot of time with me in thinking about putting this issue together, and Chris has done a great job of overviewing some of the new movements. So with that, Chris, let me hand it over to you. Thank you.
Well, thanks, Don, and thanks, Sophie, for this opportunity to share with you some of the findings we have from our recent study on looking at sustainability in capital markets. As Sophie mentioned, High Meadows Institute is focused on the changing role of business leadership in society, and one of our major program areas is looking at the role of business leadership in creating a sustainable capital market system. And we started this program in 2015. We did a landscape survey to understand what was the current state of ESG across capital markets, looking at different asset classes, different players, stock exchanges, rating agencies, as well as major asset owners and managers. What I'm going to share with you today is what some of the findings are in our recent survey and what the changes we've seen in the last 4 years since we did our research in 2015. So the most salient thing to say is that the interest and engagement with ESG has gone mainstream. We're seeing ESG investment products flooding the market in almost every investment category, from ETFs, fixed income, and alternatives. ESG assets under management now are 30 trillion, which is up from 23 trillion in 2016, and they're projected to grow to 35 trillion by 2020. Caveat on all of this, of course, is what does ESG mean? And we'll come back to that conversation later in this talk. So in the next few minutes, I'm going to take you through some of the key drivers that we found that are driving this acceleration of integration of ESG, as well as what we see as some of the challenges facing further integration. So next slide, please, Sophie. So among the key drivers accelerating the integration of ESG are demographics. A 2017 Schroeder study found that 78% of individuals said sustainable investing has become more important to them in the past 5 years. They also found that 85% of millennials had expressed an interest in sustainable investing compared to an overall average of 73%. Equally, we're seeing female investors expressing a greater interest in ESG too. Morgan Stanley found that 84% of women were interested in ESG compared with only 67% of men. So there are some powerful demographic forces behind this sort of increased interest in ESG. The second major thing that we've seen is sort of a growing recognition by market players that ESG can drive alpha. There's been numerous studies on this, and we saw in the Financial Times last year stated that outperformance of ESG strategies is beyond doubt. And in light of this, we see industry perceptions across industry are changing. Between 2017 and 2018, there was a 13% increase in the number of capital market players who said they believe ESG integrated portfolios are likely to perform better than the ones that don't. So we're seeing a move toward ESG integration in the mainstream, not simply as a marketing tool or a niche product set of offerings. Another thing that we're seeing is rapid advances in technology and data science. I'm sure you're all familiar with the term data scraping, but there are a number of specialized agencies out there now that are doing real-time monitoring on ESG data. So there's an enormous opportunity for asset owners and asset managers to get further detail on ESG performance. Some might also add, though, this is almost overwhelming, and we'll talk about that later. Regulatory changes. There's also been a proliferation of regulation globally, but particularly in the EU, that is promoting ESG consideration. For example, in France, the 2016 Energy Transition Law has strengthened mandatory carbon disclosure requirements for listed companies and introduced carbon reporting for institutional investors. In 2019, the EU published its guidelines on reporting for climate-related information. I think it's unlikely, as we'll talk about, we're going to see anything happen in the States on the regulation front in the near term, but it's definitely happening globally. Some of the most high-profile regulations introduced include a package of sustainable finance measures launched by the European Union's high-level expert group on sustainable finance, and guidelines on establishing a green financial system that were launched in China. There's also been a significant increase in policy initiatives focused on responsible investment by multi-stakeholder initiatives. According to the PRI, 50% of all policy instruments created to encourage investors to take a long-term approach have been developed post-2013. And these include the 2-degree Investing in Science-Based Targets initiative and the 2015 Paris Agreement. Similarly, we've seen the Task Force on Climate-Related Financial Disclosures, TCFD, has been gaining rapid momentum since late 2015. Another key driver is the rapid rise in investment stewardship activity engagement with companies from the so-called passive players, but also by active managers as well. I think the influence of the big three, BlackRock, Vanguard, and State Street, is no longer negligible. When their holdings are added together, they are the largest shareholders in roughly 40% of all publicly listed companies in the US. There are concerns about this, of course, and a concern that there's a misalignment of incentives, that this kind of ownership of a triumphant is creating an oligopoly of passive investors that could inhibit the efficiency of their engagement in order to benefit all corporates. However, our research and research by KKS has found this is precisely the long-term nature of the strategy and the size of their stock holdings that incentivize passive investors to engage proactively with corporations and enhance corporate governance standards. In many ways, these large players are being forced to play a role that government used to play in the form of regulation. To ensure the long-term viability of their investments, they are finding themselves necessarily having to engage with corporate boards to ensure that boards are managing and have oversight of the company's long-term performance, as you probably heard from Brian's session yesterday. Finally, ESG is being integrated by market intermediaries. Stock exchanges and credit agencies are playing a significant role in ESG integration, and we'll hear more from Tanya on that later in this webinar. Sustainable Stock Exchange Initiative has gained traction and succeeded in signing up the top 10 largest global exchanges globally, which is a 50% increase since 2015. Finally, credit ratings agencies have made significant progress in integrating ESG data into their product offerings, and all the big three have them. Well-developed ESG integration programs. One example is Fitch Ratings ESG relevance scores that displays the relevance and materiality of ESG in rating decisions. Next slide, please. Despite these driving forces, several key challenges remain before we're likely to see full integration of ESG in capital markets. The first is lack of ESG definition and standardized reporting frameworks. We have, HMI has a forum of ESG leaders and practitioners from major asset owners and asset managers, and this continues to be devil of us. There's still no generally accepted definition of ESG and no widely adopted or standardized framework for disclosure, despite progress by initiatives like SASB. The lack of standardized framework for organizations to disclose ESG information creates a market inefficiency, as financially immaterial ESG issues might not be considered during valuation. Despite the fact that there's been pressure on the SEC to provide a standard framework for disclosure, it's unlikely we will see progress on this front in the next few years. Some companies have already started to seek out more robust ways to disclose information on ESGs that are issues that are financially material by using the SASB, Sustainability Accounting Standards Board metrics in their SEC filings, or at least aligning their sustainability report with SASB. And many of the institutional investors we work with start with the SASB guidelines as de facto platform for their evaluation of ESG performance by large firms. Corporate governance. Another major challenge is the failure of corporate boards to understand and process ESG integration. A good example of this can be taken from a 2018 survey on the U.S. corporate directors, where 74% responded no when asked whether they felt disclosure on sustainability matters are important to understanding a company's business and helping investors make informed decisions. This is a major obstacle as we go forward. If the corporate boards are not on board with ESG, then long-term integration will be very difficult. Human capital. As ESG has become more mainstream, large institutional investors have grown their stewardship and ESG teams, with Vanguard more than doubling its stewardship team. However, behind this growth, there is a talent war taking place, as there is a growing competition for individuals that are familiar with the complexity of ESG issues and also are familiar with and experts in the market. In the absence of candidates with a broad range of skills required to work on ESG issues, investors need to be prepared in their professional development of existing investment managers, data scientists, and marketing staff. All of this is additional cost, of course, for firms, which it can be an inhibitor in terms of advancing ESG. Corporate lobbying. We have also seen the emergence of, maybe it's a sign of the success of ESG, that we're finally seeing some organized resistance to ESG integration and shareholder activism. Pushback, largely fueled by corporate and political interests. One such organization is the Chamber of Commerce and the Mainstream Investors Coalition. They both argue that ESG is distracting companies and investment managers from their duty to maximize shareholder returns. This, of course, is all at flux and in discussion in the current environment, but nevertheless, we have strong proponents with strong industry backing still working against ESG. Next slide, please. Finally, I just want to summarize with some thoughts looking ahead, things we expect to see. I mean, the positive side, we clearly expect to see growing client interest in ESG, especially among retail investors and asset owners. We will continue to see increased progress in ESG factors across other asset classes. Fixed income in particular is now coming into focus. Direct communication between investors and companies on ESG issues will continue to accelerate. And I think we're going to see large investors in particular moving well past third-party data intermediaries, looking for direct sources of data on ESG from the companies they're invested in. And there is, one of the obstacles currently is that, frankly, there are too many players and too many rating agencies and intermediaries. And I assume that the pressures on the market now will see a consolidation of some of those as we move forward into the future. At least we'll see some coordination. We're also seeing the impact of impact investing and systemic ESG frameworks moving beyond simply ESG as factor analysis to really understanding how these factors interplay and create a systemic impact. The obvious examples of this are Sustainable Development Goals, the SDGs, which many investors are now starting to consider, and the Task Force on Climate Disclosure, TCFD. We expect this will continue to increase as pressures mount around issues from climate change to income inequality. For example, we've seen the PRI has said that it will require all its members to report against the TCFD recommendations by 2020. Finally, when it comes to overcoming some of the identification barriers, we're unlikely to see regulators in the US play a role. However, the EU may become even more active in ESG reporting initiatives and requirements. Earlier this year, in February, the EU gave the green light to low carbon benchmarking regulation, making the first legislative agreement under the EU Action Plan on Sustainable Finance. Finally, as investors in CSG as a value driver and risk management tool, we can expect more engagement between investors and companies at the governance level. Large investors are looking for assurance that the boards are considering material issues in their oversight of corporate strategy and longer-term plans. So that's a quick summation of some of the key points from our research. It's available in the journal article you have received and available on our website if you'd like to read the whole report. I'm now going to hand it over to Sakis from KKS Advisors, who will take you through some of the major challenges we face with ESG data. Thanks.
Thank you, Chris. I'm Sakis Kotsantonis, the managing partner of KKS Advisors. And today I will talk to you about a paper we wrote with George Serafin that we call 4 Things No One Will Tell You About ESG Data. And the motivation behind this was extensive work, both in terms of using the data as consumers of information, George for his academic research and in KKS while helping investors, but most recently in trying to produce ESG data. And by that I mean to actually go through thousands of sustainability reports, construct a scoring methodology, develop and test imputation methods, and so on that we had to do for a data provider. And this exercise gave us insights that we want to share about topics that we feel are important as the ESG space is growing. Now, I understand that most of the audience are believers of ESG integration as value creation tool, but what I have on this slide is one of the latest global risk landscapes from the World Economic Forum. And you will see that we have 5 at the top that are ESG risks. This in comparison with 10 years ago, where we hardly had any, and we're talking mostly about asset price collapse and slowing Chinese economy. Today, ESG risks are a reality, and over the past 3 decades, advocates from various stakeholders groups like investors, employees, communities, consumers have sought to expand corporate reporting to include ESG data and to better understand the impact of such data on a company's performance. So what do we know so far? We know that companies with better ESG performance face significantly lower capital constraints and exhibit cheaper equity financing. We also seen latest research by S&P Global, where they found over 800 cases in the last 2-3 years where environmental and climate concerns were relevant to their rating, and hundreds of cases where environmental and climate factors resulted in a change of rating outlook or a credit watch action. We also know that portfolios of firms scoring high on material ESG issues outperform portfolios of firms scoring low on the same material issues. Now, all this research and evidence is fueled by ESG metrics and associated data. And if we think about the primary goal of ESG metrics, this is to capture as accurately as possible a firm's performance on a given issue, on a given ESG issue. And only when this goal is achieved will investors be able to use the data to hold companies accountable for their ESG performance as part of their engagement efforts, or to integrate the data into their business analysis and valuation tools. From a corporate perspective, only then will companies be able to tell when their efforts are effective in producing intended outcomes and how to systematically integrate these efforts into operating processes, corporate strategy, and executive compensation plans. But the reality is that we have seen providers of ESG data significantly disagree. That sometimes results into not really knowing if a given company is good or bad performer. And we have seen a lot of debate of why this is happening, like differences in defining what good performance means, differences in the methodology, and so on. But we want to dig a little bit deeper. So the 4 things that I want to discuss today are the following: that data inconsistency is worse than you think it is. And a lot of people talk about it, but not many have actually realized what it actually means. Benchmarking groups can affect results and introduce discrepancies on ESG scores. ESG data imputation can be a problem, and one that hardly any data provider wants to talk about. And data providers disagree a lot, and surprisingly so when there is information. And throughout the slides, I want to make this visual, and I'm going to be using some simple normal distribution graphs like the ones that you see on the screen. So whoever has access to their laptops and our presentation, please have a look there. And the idea here is the following. In an ideal case, for any given ESG metric, we would want to see a normal distribution of performance. Some companies will do great, and they will be on the right-hand side. Some will do bad, and the majority will perform around the mean value. In such an ideal case, it's very easy to say for any company how well they do, given the relative position in that graph. So keep that in mind as we move on to the next slide. So data inconsistency is worse than you think it is. So inconsistency in the way different companies report ESG data is a commonly cited challenge when trying to analyze the effects of ESG investment and performance. But what form does this inconsistency take, and what kind of problems does it create? So to provide more context, what we did is select a random sample of 50 large, all Fortune 500 companies across a variety of sectors. And for these companies, we hand collect information on how they report on the issue of employee health and safety in their latest sustainability reports. Well, employee health and safety, right? You would say this would be a very straightforward issue to report on. Actually, it's not. What we found is that there are more than 20 different ways that companies report their employee and health and safety data using different terminology and, most importantly, different units of measure that you see on the table there. So what challenge does it create? If you look at the graph on the right, we don't have one anymore, but multiple distributions that can be used to assess employee health and safety. And it is not certain that the same companies will be doing well on all. And also there's a question of which one do you choose? Do you aggregate all? And if yes, in what way? Should fatalities get more weight than injuries? The problem here is that these decisions are inevitably made by a data provider and could be a source of major discrepancies. Now, let's move on to what we call the mystic art of benchmarking. The way to explain this is again by looking at this graph of normal distributions. Let's consider now two different groups of companies, as shown in the figure, that are used to evaluate gender diversity as measured by percentage of women in the workforce. The main difference between the blue and the green group is that in the peer group B, we have more companies that perform at the top end of the distribution, which means they perform well. Now let's assume that we want to understand a company's relative performance, which is the red circle, on the given ESG metric, as compared to each of the two different peer groups. As shown in this figure, the same company will be assessed very differently in the two cases. It will be very well among the mean value and close to the top performers on peer group A, but it would sit slightly over the mean with peer group B. And you can imagine what's happening when different data providers are using different peer groups. We have seen in the market the use of universal peer groups. So let's say we compare diversity across sectors, but this introduces sector biases. Industry peer groups tend to be more often used, and here you can see part of the challenge there. This exercise made us also think the case of diversified businesses. A company like American Express, for example, that has a primary classification of specialized finance, but also makes considerable revenues from their operations under data processing and outsourced services. If we group them according to the primary classification, we might be missing some great initiatives and strategies that are using to advance their practices on the secondary classification. Or if you think it the other way around, some major ESG risks. And what if they are leaders in terms of the practices? We just missed another data point that would alter that distribution and as a result, the scores of every company. Imputation. This is actually one of my favorite topics lately. So we have just established that even in the presence of disclosure, it's really hard to judge what makes for a good or bad ESG performance. But what happens when there is no disclosure? The lack of regulation, the lack of standardization that Chris mentioned around ESG disclosure implies that not every company will report on ESG issues. And those that will not do it, they will not do it in a consistent way. So in the same sample, of 50 companies, about 15%, 1/5, disclose their lost time incident rates and workplace fatalities. So the implication is, from a research perspective or from an investor perspective, we have the problem of dealing with vast data gaps that span ranges of companies' time periods and metrics. So now the big question, right? How can data providers claim to offer full coverage on ESG data and analytics for vast universes of companies and long time series when the data is not there? This is where data imputation is likely to play an important role. And although it's rarely discussed by ESG data providers, their approach to impute data has the potential to be a major differentiator on how they do deep gap filling and deliver drastically different results. So imputation will directly affect the rankings of companies on ESG metrics. What we have here on the table is different techniques that can be used. You can have rules-based approaches where you basically assign a sector average or just penalize non-reporters. You have input-output models that are commonly used with environmental metrics, where industry level and macro data are used, and more advanced statistical models like regression analysis and so on. Without making this overly technical, I want to give an example of the differences this can create. We use these different methods to try and predict a data point that we know, which is Lufthansa's turnover rate, employee turnover rate in 2017. We know that this is 12.9%, and we use all different approaches to try and predict this. And as you see, we're always off, and we give you the numbers, the deviation from the actual number. So if we use a rules-based approach and we give them the worst performance, we're 7% off. If we give them an average value within an industry, 4%, and so on. So keep that as another point on a source of trouble there. Now, finally, some latest research that my colleague George will be publishing soon. If the lack of agreement about metrics is the problem, then we should expect that when we evaluate companies that disclose more information, ESG analysts might use different metrics and then disagree more on the assessment of those companies. But if the main problem is really the lack of disclosure, as many people claim, then we would expect less disagreement among ESG analysts when evaluating companies. Actually, the findings of this research shows that companies that provide more disclosure tend to create more disagreement or variation in their ESG ratings. So stay tuned for the full paper. This is going to be coming soon. Now, finally, I want to close on a positive note and not overly negative, because it's not all about being cynical. Can we enable better risk management through better data? Yes, but it requires an effort from all sides. So we believe that companies need to take control of the ESG data narrative and accept a reasonable baseline of ESG metrics, to also self-regulate in ways that aim to provide comparability, from investors to push for meaningful disclosure of metrics, from stock exchanges, and Tanya will be talking about that, to give serious consideration to issuing guidelines for and even mandating ESG disclosure, and finally from data providers to come to an agreement on best practices and become as transparent as possible about the methodologies and the reliability of the data. Thank you. I'll pass it on now to Bob.
Thank you, Zakis. I appreciate the opportunity to be on today, and thank you for illuminating the issues around data usage. We encounter those same issues all the time. Let's see, first slide, please. Thank you. So Inherent Group, we're a 14-person investment firm with expertise across the capital structure, and that is active in debt and equity markets globally. What differentiates us is the way that we use ESG as a value creation tool, and the way in which we integrate ESG into each step of our investment process. So what do we do here? Like other top investment organizations, we're looking for asymmetric risk reward. But we also seek to use sustainability-related engagement as a tool to unlock franchise value. In our view, businesses that are perceived by the market as more sustainable are, by definition, more durable, and therefore meriting a lower cost of capital. Conversely, we believe the opposite is true as well, and this is the overarching philosophy of our firm, that sustainability matters to the cost of capital and therefore to valuation. Now, the investing community is quick to attach to examples where sustainability or ESG issues drive value destruction. For example, in the opioid crisis or in California wildfires and the activities that preceded those. But there are also areas where prioritizing products and services that address societal issues have the potential to help lower the cost of capital. And we have seen this shift, for example, in the way that companies in the area of renewable fuels and in packaging, in cyber/digital privacy, we see examples in the way those companies are changing their behavior real time. Our goal as investors is to identify and engage with those companies where these real-time sustainability-related changes are taking place and where those changes can drive lasting value. Now, if sustainability drives or helps to drive the cost of capital, then figuring out which sustainability factors are financially material to an enterprise is critical, and that is where we spend much of our ESG effort. In general, along the lines of what Sakis just described, we find that data is insufficient to define and discern financial materiality. We look to SASB, we look to databases for clues, but to us, the richest data source is a dialogue with the company. Because we engage with management, not just on standard capital allocation issues, and because we don't come asking for managements to comply with a vast series of benchmarks that may or may not be relevant, but instead with a genuine desire to improve the operations of a company, we tend to have a more fulsome dialogue than we otherwise would. It allows us then to discern which issues truly are financially material to the business. Now, assuming a company is an attractive investment prospect, we begin a long-term engagement process in earnest, where the goal of that engagement is to focus management's attention on the one or two key material sustainability issues that can unlock or preserve value. Next slide, please. So what does that engagement process really look like? There are 5 features that I'll talk about. Well, this slide appears out of order, actually. Could you flip to the next slide? Yeah, there are 5 features that I'll talk about. First, as I was mentioning, we try to establish materiality, and we do so primarily through dialogue with the company. Now, financial materiality is going to differ by company, it's going to differ by industry. Tech obviously could have different issues associated with it than an industrial company. And as I said, we might start with SASB or other data sources, but we really get traction on discerning materiality through dialogue with the company. Now, a couple of examples where we found material issues that may not have been as obvious looking solely at data include a renewable energy company where day-to-day safety issues were having an impact on retention and morale. And so we engaged directly with that company on their safety reporting and are helping them think about KPIs to report going forward, not just to give investors a sense of these issues, but their employees as well. Another example is in the healthcare space, where resetting executive compensation to include key product quality metrics really, in our view, can drive lasting value, but also protect the company from existential risks. After all, healthcare is an industry where quality is a matter of life and death. So second, we need an action plan. And that action plan, as I mentioned, it really needs to be focused on 1 or 2 priorities. And in our effort to establish that action plan, we set up what we call our ESG workbook, which is where we start laying out the KPIs of the company may have in place or that we think are relevant based on our review of other comparable companies. But to Sakis's point, benchmarks are oftentimes misleading, and so really that workbook becomes a collaborative effort with the company. From there, we then decide what to press on and engage with management in that respect. Now, the next piece here, the culture assessment, this is something that I think really differentiates our firm, and this is something that draws on the work of George Serafim at Harvard, who's on our advisory board. He has published on the topic of high-performing cultures and has come to the conclusion that those cultures that exhibit the characteristics of purpose, which essentially means some sense of pride beyond a paycheck, and clarity, which means employees and management having clearly articulated short and long-term goals. Cultures that hit those two dimensions tend to outperform over time. And so what we've done is we've developed what we call our culture survey, which is a lengthy list of questions that we engage the company on over a period of time, where we endeavor to speak to multiple different levels of seniority within that organization. It's distinctly not just a C-suite exercise, but instead is really intended to get at some of the technical, the middle management, individuals who may be form sort of the body of the corporation, because that's where we think we get the best information. What we try to do is we try to ask questions that are unusual, questions that highlight and that don't allow the individual we're talking to resort to canned answers. So, for example, one of the great questions we like to ask is, tell us something you're least proud of in your industry. Oftentimes, the response we'll get is, wow, that's an interesting question, and oftentimes it'll lead us to a place that a risk factor that we weren't aware of. It'll show how thoughtful the individual and the company is about the risk facing their business. And then what we try to do is we try to compare responses across the different layers of the organization to see if we find consistency. So the next piece here is collaborative engagement. I emphasize collaborative. It really is a partnership with the company. Once we've defined materiality, establishing KPIs is a two-way discussion. It is no way us imposing our views on the company, as they know their business better than we do. We usually formalize those requests that we make to a company in letters or other materials that we send to them. That can be to management or to board members where relevant. And this is not just to sort of re-emphasize points that we may have made in the past. What we find is that those materials can get shared within the organization, and that then leads to opening up other channels of communication for us, which then feeds back potentially into the culture survey I was talking about. It enables us to get to other layers of the organization. Finally, we need a way to hold management and ourselves accountable to the KPIs we set forth. And so really that is blocking and tackling. It's maintaining an active dialogue with the company, with a point person at the company who we decide in advance is going to take responsibility for shepherding the work that needs to be done, and just continuing to push over time. In that effort, we do track internally every conversation that we have, and that's one way that we are able to hold ourselves and management accountable to what has been said in the past. Next slide, please, or previous slide if we're, I think, in the other order. So, okay, so process. So on this slide, it's a busy slide. Up top, we have what looks like a traditional investment organization, fundamental investment workflow at top. And then we have the ESG workflow at bottom. And the point really is just to say that the two are integrated with each other. They're conducted in tandem. Each analyst who is working on an investment idea here is also working on the ESG underwriting and associated work in conjunction with Paul Aleph, our sustainability lead. Now, what's the goal of a process? The goal of a process in traditional investment, in a traditional investment sense, is to improve the repeatability of successes and reduce mistakes. It's to create a pattern recognition through iteration. We're ultimately sourcing benefits from the successes and failures of other steps in the chain over time. In ESG, it's no different. By running a consistent process, we believe that we will get better at identifying, engaging on, and capitalizing on the financially material sustainability factors for each business. Now, I've spent a lot of time previously talking about what engagement means for us, because that is where the rubber really hits the road, but we do integrate ESG into every step of our process, and that starts with sourcing. Organizationally, we are thematically organized, where each analyst is responsible for a sustainability theme, for example, decarbonization. And that thematic organization really forms the top of our investment funnel in many respects. That can lead to both short and long opportunities. Understanding which companies are on the right side or the wrong side of a theme is important to creating alpha over time. Now, the screens we run also tend to be a little bit different and influenced by ESG factors. For example, one of them, and we have several, is what we call our cult of personality screen, where we look to uncover businesses at risk from a long-tenured CEO that has sort of less meaningful governance restraints around him. Now, in the underwriting process, I've mentioned the ESG workbook and the culture assessment. That's where these processes begin, it's important to note that those processes are long-term projects. They are not one-offs that get done in advance of making an investment, but rather projects that go on throughout the underwriting and execution phase and beyond. It takes a lot of work and effort on both fronts, the ESG workbook, the KPIs, and really understanding a company's culture to come to a conclusion. Now, on engagement, that also, of course, spans the pre- and post-investment time frame. There are companies that we have engaged with for over a year at this point, and that really does, it works like a partnership, like I described before. We work with management to create, call it an ESG action plan. I mentioned we try to designate one person as a point person at the organization to work with us on it. And then that person is empowered, hopefully, to reach out into other areas of their organization to draw on resources as needed. So in a way, we hope through our engagement that we help the companies figure out who to empower and how to support those people in order to effectuate the change that needs to be made. Importantly, and I keep mentioning we look for one or two issues at a time, we have found that at least for most of the companies that we engage with, their sustainability staff or the people they're able to allocate to these efforts are sometimes thin, oftentimes inexperienced, as many of us in the sustainability field are, and so it's important to sort of stick to one or two key issues that we really think are going to drive value. And then on reporting or monitoring, I mentioned we would track every interaction we have. We find that's a good way to hold management accountable. The point is really just to keep hammering away, make sure that the company remains focused, make sure that the person that's empowered has the resources they need, and so on and so forth. Finally, proxy. We have a proxy tracker that we've listed up there. We try internally to track, or we do internally track every proxy vote, why and how we voted a certain way for each company, to make sure that the votes that we're casting are in line with our priorities and values as a firm. Next slide, please. Okay, so just summing up, we see business and capital as being uniquely positioned to address societal issues. They have the scale, the incentives, and the money. You know, slide is a little bit confusing, but you know, the point here is that society, we see society as asking for real-time change to take place. We see governments, some more than others, creating the conditions for prospective change. And what is our role in all this? We help companies see that it's in their self-interest to pursue financially and material sustainability initiatives, both for risk management as well as for creating new opportunities to create products and services. We think investors and companies are currently undergoing the difficult work of developing a common language. We think the data is not there, the language isn't there, the communications therefore can be halting and complicated. But we think that a language will eventually emerge, and from that, expectations in regard to the way that companies interact with the environment and the communities in which they operate. We believe really that the cost of capital is increasingly going to reflect on these currently unpriced externalities. So with that, I'll turn it over to Tanya to talk about ESG innovation in stock exchanges.
Thank you. Hello, and thanks everyone for tuning in, and thank you to the previous speakers for their contributions. I've been taking notes throughout, actually. Today I'm going to be talking about how stock exchanges and, well, market intermediaries, but particularly stock exchanges, can facilitate and drive ESG disclosure and performance in their respective markets. And I'm going to be drawing from the Athens Stock Exchange perspective and the Greek perspective, which is the organization I'm representing today. Can we have the next slide, please? So I think at this point, both in the webinar and generally, it's quite well established that ESG issues have a significant financial impact and thus are quite material for investments. We've seen a growing body of research confirming that there is a link between ESG performance and asset performance, and specifically that firms with good ESG performance on material ESG issues, and I want to stress material here, tend to perform better than firms with poor ESG performance in the long term. Of course, we can have a very interesting discussion, and I think previous speakers are better placed to discuss this to a deeper extent than I can about what constitutes good performance and what definitions would make sense. But I think what we can agree on is that there is a likelihood that these ESG issues do affect a company's risk profile, affect its ability to create value in the long term, and of course, through all these channels, they affect its valuation and its performance. And I feel like this is also, of course, the reason among the call to action that we've seen from things like the SDGs and the overall mobilization around sustainability, but also the financial significance has contributed to the increasing uptake of investors who are embedding ESG information in their financial decision making. And this makes a lot of sense, of course, that asset managers and asset owners are doing this because it can offer a lot more insight and help them accurately price and assess various risks and opportunities. So we established that for companies, it is important to have this good performance, and it does affect their ability to attract capital on better terms and to perform better in the future and to optimize their operations. But of course, on a larger scale, this is important for the capital market as a whole. So for a local capital market, like for example, the Greek one, having enhanced transparency and having good governance on ESG matters can reduce investor uncertainty and build trust. And trust is necessary, and I will go back again to a market like Greece, who is now in the turning point where in the post-crisis era, it has a high need for investment, and it does need to attract this capital. So by reorienting the capital market and the companies towards long-term value creation, enhanced transparency and good governance, we can see wider benefits in terms of attracting an investor base and accessing capital on better terms. But beyond investor interest, another driving force we've seen in Europe, and that was also established in the beginning by Chris, has to do with regulatory developments. I want to talk more about the EU Non-Financial Reporting Directive. The directive sets out a framework about reporting certain non-financial information, ESG information. It's a bit more general, but still it is a step in the right direction, and combined with the results of the high-level expert group on sustainable finance, it does hint at the fact that while this mobilization is now beginning and it's mainly tailored to larger companies and public interest companies, we will be seeing a lot more of that in the future. So we're expecting the mandatory reporting of non-financial information to be expanded in the future. And so what we're faced at as a market intermediary right now is when it comes to companies' ability to both respond to investor information needs and to also be able to stay ahead of regulatory developments. There is the problem that Sakis laid out really nicely in the beginning, that we have a lack of general standards for ESG disclosure, and this of course results in a scarcity of comparable data on material ESG topics. We lack the benchmarks that we need to make the right conclusions, and all of these things together combined lead to will form obstacles in the incorporation of non-financial information within traditional financial and investment analysis. So in order to mainstream sustainability in capital markets and to be able to help companies reap the benefits and take advantage of the opportunities that present themselves through ESG, we need to enhance the level of disclosure. We need to enhance the quality of data. I want to make a note here that we're not talking about necessarily more disclosure. We're definitely talking about better disclosure. So in the Greek case, non-financial disclosures have largely been described as fragmentary and poor and oftentimes qualitative. So what we need now is to have meaningful and comparable data that can actually be used in investment decisions. And this is where stock exchanges can play an interesting role. And I will like to move to the next slide, please. So exchanges can play a very transformational role in markets, and that is because as a market infrastructure and market intermediary, they are positioned between multiple stakeholders. They're positioned between companies, regulators, and investors, which then means that they have the ability to use their institutional capacity to advance transparency and to develop more efficient capital markets that are oriented towards long-term value creation. So exchanges have traditionally had the ability to influence the governance standards and the business practices of the companies that are listed in their markets. And of course, that can happen either directly through listing rules and disclosure obligations that are set out in order to list in a market and keep trading in a market, or at the same time that can happen through a more voluntary approach, through the dissemination of best practices and through different incentives that make companies want to take up either corporate governance standards in the past and now ESG reporting. The interesting thing, though, is that stock exchanges not only have a large influence on the governance practices of their listed companies, but they can begin to create new business norms in a market on sustainability in this case that will have an effect also on non-listed companies. So there's a lot of potential to use these market infrastructures to enhance the overall level of disclosure and to improve performance and to mainstream sustainability concerns and ESG in markets. So far what exchanges are doing is that they're self-regulating. So one pillar is raising awareness about the importance of ESG in their markets, and that happens by essentially helping companies through either events, trainings, helping them understand the importance and the long-term benefits of incorporating sustainability considerations within their operation. And then the other thing that they can do, which is a lot more actionable, if you will, is to help close the disclosure gap and guide companies and remove some of the burden, if you will, of making sense of a very complex landscape that, as we've established already, is ESG right now, by simplifying the process and issuing guidances, ESG disclosure guidances. And these guidances function as tools that help issuers improve their disclosure practices and disclose, I guess, better quality information within their capital markets communication. And in that sense, they can build the link that ensures that companies are not just transparent, but they're transparent on the issues and in the way that can be useful to investors to facilitate ESG integration. These guidances often are on a voluntary basis, but as the years are going by and as more and more companies are adopting better disclosure practices around ESG, we're seeing some stock exchanges developing their initial voluntary guidances into listing rules. So I think that's the case for the Toronto Stock Exchange and the Johannesburg Stock Exchange, and I have a firm belief that we will be seeing a lot more of that in the future. The other thing that exchanges can do, which is more the incentive approach, is to provide incentives for companies with good ESG performance by either developing sustainability-related financial instruments, that would be something like green bonds, for example, or by developing trading and benchmarking products. So that would be something in the form of an ESG or a sustainability index. Through all these things, what exchanges can do is encourage sustainable investment, of course, and help companies disclose better information that also can respond to the needs of investors. So if we can move on to the next slide. What we're doing at the Athens Stock Exchange now is we're doing something that in its early, I guess, description is not something insanely groundbreaking, but for us in our market, it is. And by the virtue of the tool that we've created, it also is something quite innovative. We have developed, we're starting, I guess, an ESG initiative. So we're initiating a series of actions that aim to enhance and build awareness about ESG in the Greek capital market and to sort of close this gap among our listed companies in the beginning. So we've developed a customized ESG reporting guidance to help companies enact best practices and implement reporting frameworks and provide investors with more credible and comparable, in any way that we can, ESG information. A lot of exchanges are doing this. They're issuing ESG guidances. The difference in our guidance is that it has a strong focus on materiality. So what we want to make sure is that we want companies to be able to apply the concept of materiality using our tool to determine what the material issues in their industry and sector are, and to ensure that they're reporting on issues that are directly related to their ability to generate value in the long term. How we did this was we developed this guide by drawing from the best practices outlined in sustainability guidelines like the Sustainability Accounting Standard Board and their industry-specific standards. We've also drawn from reporting frameworks like GRI, CDP, and the Greek Sustainability Code. And we had also an overview of the existing reporting practices in the Greek market, because our main concern was to have this translated and localized in a way that makes sense for our local market, and to ensure that companies that are already reporting on this information don't have to start from scratch and do something completely different to what they have already implemented. Now, within our guidance, we've proposed a metric structure, which is something we propose specific metrics, and each metric is supplemented with reporting guides that help companies understand what they need to measure and how they need to measure and disclose it. So it might even be going down to the units and the relevant standards within the different reporting guides. And our metric structure is organized in a way where it's comprised of economy-wide and sector-specific metrics. Our economy-wide metrics are split into two categories. We have our core metrics, which is, I guess, the ultimate baseline of what companies need to be reporting, all companies, regardless of their sector of activity or their business model. And then we have advanced metrics, which are developed to help ESG high performers enhance what they're doing, improve on their work, and showcase what they've achieved so far. And finally, we have our sectoral metrics, which focus on helping issuers apply the concept of materiality. So in a sense, what that means is we suggest this might be more relevant depending on your industry versus something else. And of course, that materiality exercise has to happen at the company level as well, depending on their business model. But this is sort of an initial guide to help everyone be able to report this information and do so in a way that has high quality, that is comparable, that is quantitative, and that can be used by an investor. So what we want to achieve with this is we want to establish the framework through which companies can disclose this information. And following the publication and dissemination of this guide, which will be happening within the next month, we want to begin developing also a benchmarking and scoring tool that will help us get an idea of where Greek companies are. And I'm sure we will encounter an array of problems that were described by Sakis initially. But it's important for us to be able to assess the situation and see how we can move forward and see whether there are any improvements, even on a year-on-year comparison. This is also a relevant thing to know. And what we aim to do with the tool is to create a sort of race to the top effect that will lead the companies to make significant improvements in their processes, in their performance, and in their governance. And the ultimate aim, of course, is to build capacity in our market and to help mainstream and embed ESG, and of course, set the ground for any future developments that concern sustainability-related investment products. I'm mindful of time, so I'm gonna stop here to give you some time for questions also.
Thank you, Tanya.
Thanks so much. Sophie.
Thank you, Tanya, and to all our speakers today as well. And unfortunately, as Tanya said, we have run over time slightly today. So unfortunately, we don't have any time for any live questions, but please still send these across following the webinar. And also feel free to type them into your platform now. We will pick those up and we will endeavour to respond to you all and pass them on to the relevant people. Before we close, I wanted to make you all aware that we have added 2 handouts to the webinar today. You can see these by clicking on the document image on the right panel of your webinar screen. The first is today's slides, and the second is the full special issue on sustainable financial management that the Journal of Applied Corporate Finance have generously shared with all participants, featuring the work you've heard about across this webinar series and much more. We will also be sending the slides and the sustainable financial management issue in an email to all those that have signed up on Monday next week, along with a recording of today that we'll be uploading to our KKS YouTube channel. We encourage you to share this recording with any colleagues that might be interested. I also wanted to let you know that you can subscribe to the Journal of Applied Corporate Finance by visiting their publisher, Wiley's website. The journal is published 4 times per year, and they have a range of subscriptions on offer, including for students, individuals, and institutions. All that is left for me to say is thank you for taking the time to listen. I'm sorry we've run over slightly, so thanks for staying with us. And thank you to all our speakers. We hope you have all enjoyed it. You can stay up to date with our latest research and thinking and sign up to our newsletter by visiting the homepage of our website at www.kksadvisors.com. Thank you and have a good rest of your day and evening.